Joining us with his take on the road ahead, Goldman Sachs chief U.S. economist David Mericle. David, what a treat for us. Good to see you.
Thanks very much for having me.
How are you thinking about this so-called growth scare given this morning's prints, or this week's prints?
You know, we were always a little bit skeptical that the economy would just sort of suddenly, spontaneously turn down. I think we obviously have seen a deceleration from 2023 to 2022, but that's fine and to be expected. The economy grew over 3% last year. Job creation was very rapid because we were in the midst of this big immigration boom. That's cooled off a little bit, and we seem to be converging toward something more like a normal growth pace in the low to mid twos, but certainly a long ways from actual decline. That's what this morning's consumer spending data suggests. And I think all of this has a lot of implications as well for what's been the big debate for the last couple of weeks. How healthy is the labor market? Because if final demand is growing at a good pace, it would be very odd if companies didn't need more workers rather than fewer. So We continue to think that everything's working out pretty well.
I noticed you keep chipping away at your core PCE forecast. What are you down to now?
We're now down to 13 basis points after this morning. We had a big decline in international airfares in the import price data. That will flow through. So another soft month. I think the bottom line is we've solved the underlying problems here. We rebalanced the labor market. We got inflation expectations back to normal. We actually had really done all of that by last year. It's just that these inflation reports can be a bit bumpy from month to month. We think there are some seasonal adjustment problems as a result of the big fluctuations from the last few years. That created some upside in Q1. We've seen some softer prints more recently, but we're trending in the right direction, and I think you need to zoom out and focus on that.
As for the labor market, what is the line that sort of delineates danger from safety, so to speak, coming up in this next print?
Yeah, we're thinking that the July report will turn out to be a bit of an outlier, that job growth is probably running more like 150K, that the increase in the unemployment rate reflects an inability to quickly digest what has been a huge surge of immigration, but one that's now cooling down, but that it's not reflective of overly weak labor demand. So if we see job growth come in closer to where we put it, trending at around 150,000, if we see the unemployment rate stop rising, or we think a bit more likely come back a little bit as some of those temporary layoffs reverse, then I think things would look fine. The Fed would feel good about where we are. And I think markets and Fed officials and we would agree that in that circumstance, a 25 basis point cut seems right. If we get a much weaker jobs number, then I think it does raise the question of whether this is supply or demand driven. It's difficult to disentangle the two in real time. We do expect job growth to slow because labor force growth should be slowing as that immigration surge dampens out.
Finally, we haven't really mentioned much about former President Trump's comments yesterday, sort of opening the door to not just Chinese tariffs, but universal tariffs of maybe 10, maybe 20. I know you guys have done some work on the potential on the impact that might bring to the economy and inflation if he does win.
Yeah, that's right. If former President Trump does win, we do think that there would be tariffs. I wouldn't necessarily assume that everything that's talked about on the campaign trail eventually becomes policy. But we do think more likely than not that there would be some additional tariffs on China and maybe some additional tariffs targeting autos. The really big tariff that's been talked about would be an across-the-board tariff of 10% or more. That one we think is a possibility that deserves to be taken seriously, but one that we would not say is the base case at this point. If we do get further tariffs, the impact of that on the economy would be to raise prices, boost inflation, but you want to think of that as a one-time boost to the price level, not a recurring source of inflation. So I think that's how the Fed would manage it. It's possible if the tariffs were large enough that it could be optically awkward to continue cutting interest rates as higher inflation numbers are coming in. But I don't think it would make sense to kind of panic and see this as the sort of inflation we were dealing with a couple of years ago, where you really didn't know how long it would last. So, they're not going to hike. Could it disrupt cuts? Perhaps if it does happen. We also saw in 2018, 2019, that there was a growth scare around the tariffs, that the equity market got very anxious. And in the end, for the Fed, that was the most salient takeaway from the tariffs, not higher prices, but rather the perceived threat to the expansion from the tightening in financial conditions. So that's another complication in all of this, the question of how does the market react?